And Jayakumar, Jakes, Managing Director, Prime to just take our conversation forward. Jakes, Happy Navratri, Happy Dashera. You're changing colors. Never seen you in an Indian attire. Only time I used to see you in an Indian attire was Diwali. Now Diwali and now hopefully Dashera and Diwali both.
Well, I guess it's the time of the season when you get invited to important channels in the market. So you need to be, when you go to war, you have to be dressed for war, as they say. But this is not war time, other than in certain parts of the world. But thank you for having me over, and wish you and your investors and viewers the very best.
Jakes, it's been a good year. It's really been a good year, given that what is happening in the world, how interest rates have been volatile, how tricky it's been to call global flows in the global picture. I guess Indian markets have done well for themselves. So why is that?
I think the underpinnings of the market have everything to do with a set of investors, a certain set of events which we don't talk about enough, which is the retail investor. For too long in my working career since 1985, that's now 38 years, we've only heard, little jibes and jabs about investors creating, the tops when euphoria is, rife and people sort of jump in. We've heard of them selling out when panic is on the screen and stuff like that. The reality is that the investors, the retail investors in India, courtesy, I think principally the SIPs that have grown almost 10x over the last 6-7 years, now aggregating almost 16,000 crores a month, which is about $2 billion, and that annualizes about $25 billion. So you're talking about some serious money. And we've always looked at what we call the poster children of the market, which is the FII inflow. And maybe that's something that needs to change and change quite dramatically. Which is that the FIs have actually been sellers, and against that headwind, we've had retail investors, not a single retail investor whom we can name in a sense, but folios have increased, demat accounts have increased, and their SIPs, the allocation to Indian markets has increased, and that's been, to my mind, what's been buttressing this very steady rise, nothing euphoric, but a very steady rise in the Indian markets.
Yeah, absolutely. Jakes, hi, morning. You put it rightly, and I guess that is what's showing India's resilience at a time when you've got so much wobbliness across the globe. But tell me, in your notes, you've talked about how the Ds have it, and they've never had it better. Highlight for our viewers what makes India's bullish construct intact, according to you.
I think for starters, we've had, I think the entire, the policy-making initiatives, which, at the margin have been probably aimed towards regions initially, then towards countries. And now, whether by default or otherwise, which is another D, we probably are, at the helm of everyone's attention. And any policy-making of any kind in the world, geopolitical, can't ignore, I would say, the Indian reality. That's number one. Demographics have always been there. So this entire population that's been seeking, jobs to consumption, to everything else, the startup economy, it's all been driven by that 20 to 40 age group. And that's the second D, which is there. Demand's always been there. Demand, especially in the context of an extremely uncertain global environment and aging populations in most parts of the world. Whether you take Europe or you take now, interestingly, China. And China now is actually paying pretty dearly for its one-child or two-child policy that they've had for a while. And these policies have actually meant that the working population and the younger age group have actually been depleted quite a bit. And the aging population is just not making consumption and any stimulus-driven consumption happen. And an economy that's been principally driven on exports, and in an environment where global economy is weak and the local demand is weak, China has been actually coming a distant number two in several comparisons as far as India is concerned. And I think, as I said, this particular confluence of various events is really what's created this dramatic move towards the Indian Ds, whether demographic or demand or any of the, or digital, for instance, the entire growth that's been led by technology. And technology at the end of the day is one aspect which makes for a finite input and potentially an asymmetric output. And that's the kind of a change which the digital shift in India has created. That with finite interventions in various parts, whether it's direct benefit transfers, whether it's the smallest thing in terms of Aadhaar, etc., the digital economy, the purchasing, virtually everything is now turned digital. So I think there are very few things that I can look back and say that we haven't done, whether by default or by design, which haven't turned out great from a confluencing perspective at this point in time. And that, along with this retail SIPs, is creating this huge global oasis where people are desperately looking for avenues to invest in. And especially over the last couple of years, where people, most parts of the world, have lost money on equities, have lost money on bonds, have not made money on precious metals. And really, therefore, people have lost out on most asset categories. And in that context, India has stood out like a beacon. And I think that's where it is. And, without meaning to even talk too much about it or jinxing this, but this is really the construct around which I think the next 8 to 10 years for sure will or should pan out.
But you think, Jake's interest rates remaining elevated, crude largely around, 85, 90 odd, could that challenge us in the near term in any way?
If the global economy is going to be as weak as it is, I don't think crude really goes above this 9,500 levels. I, for one, am not in the camp that believes that crude will move up, especially in the context of, interest rates potentially remaining elevated for at least some length of time. I'm not too sure if crude will also play ball along with it. I think the bigger structural issues are around the American balance sheet, where nearly $30 to $32 trillion of debt are being supported on an average at about 3 to 3.5% of borrowing costs, which is $1 trillion of interest liability every year. And in that context, and with the paradox that most people in the world are still borrowing in dollars, you have this amazing paradox where there's demand for dollars from a borrowing perspective or from being used as the currency of the currency standard, and you have the US debt at this levels. So there is, it's very clear the US can't print its way out. And I believe, therefore, that as interest rates move higher and higher, or have moved higher rather, and perhaps are very close to peaking out, and maybe another 0.5% more is my take on it. So I think in the 5.5% range, we should be peaking out. Interestingly, if you go back in history, every time interest rates have been this high, people have moved towards real assets, which means everything from capex to capital goods to reconstruction. So is it conceivable that the next 20 years in the US, you have a demand led by an infrastructure boom where everything from airports to bridges to pipelines, etc., not just privatized but reconstructed? I think there's a real possibility that Europe will follow suit, and that's the way the US will move. And this may well be the model that as interest rates remain much higher than they have been in the last couple of decades, you will have an infrastructure boom, you will have a capex-related boom as the world moves towards real assets compared to what it's done in the last 2 or 3 decades. So I think that itself is another export-led advantage for India, where India is the manufacturing capital. If we were to sort of arrogate ourselves to that position, could well be hugely benefited as manufacturing exports could take off in a massive way over the next couple of decades.
Jakes, why do you like pharma? I mean, this is one sector where it's been difficult to call the earnings trajectory. Sometimes it is US FDA, sometimes it is pricing power, sometimes it is both. Post-COVID, the sector got re-rated, then massively got de-rated. Is it looking prime for a comeback?
Well, I think for one, the under-ownership has never been higher. Number two, people have viewed this sector as a trading bet rather than as a structural bet. Number three, it's also true that the common man, especially in most parts of the world, like especially in the US, is hurting. And therefore, insurance companies and the move in general towards cheaper generics rather than patented drugs, that move has never been stronger. The voices have never been more strident. And I think that move will ensure that the Indian generic space So in pharma, we can't take a broad sweep. I would look at the generic space, and I would look at key areas like the PLI, which is an incentive which the government has given for domestic manufacturing, especially of critical inputs. So companies that are either in the generics dominated or have got exposures in the PLI, and domestic pharma in general has been growing, but growing quite steadily, nothing spectacular. A combination of these two, valuations are on their side, balance sheets are relatively unleveraged, and most importantly, ownership is very low. If you take all this into account, I think pharma could be a very interesting space, which will, I think, continue to get money much more than the trading kind of box that we.
And what's making media so appealing?
So if you compare media with FMCG, which is a comparison I've drawn up more to justify my arguments, I suspect, but it's still under-owned. Media exposure for most funds is very, very low, number one. The media sector, like the FMCG sector, is consumer-facing. It's as competitive. And unlike the FMCG space, it's actually dominated by 2 or 3 groups only, which account for pretty much most of the listed and media exposure in the country. So a combination of that, balance sheets are relatively healthy. In fact, some of the media balance sheets are very positive in terms of cash richness, if you will. And the most important thing is valuations here are 1/3 to 1/4 what FMCG peers command at a time when we justify FMCG by saying most of it is habit formation, that we buy the same toothpaste, we eat the similar food, similar brands, and challenger brands are also given valuations that are reasonably compelling. Yet in media, that's not the case. And if you really look at it, media watching is about as habitual and as habit forming as you can get. So the comparison with FMCG is very high, competitiveness is high, the granularity of pricing power, etc. is high, and yet valuations are 1/3 to 1/4, and ownership levels have never been lower.
Okay. Good to have you on board. Thanks as always for joining in and giving us more clarity as to where your preference lies and views on the markets.